Agrawal. I represent Asia Tech. We're doing this session, as a partnership between Tyke and Asia Tech Journal. And Saurabh, like I said, it's a pleasure to host you with us. Excited to see the kind of work that you're doing and the discussion that you're bringing in the healthcare industry, right? In a very interesting intersection, right, which is that of healthcare and fintech. This has been a segment for the longest time. There are people who have tried to sort of solve it, right? And and the models have happened. For a variety of reasons, these are models that have not necessarily made the kind of impact that they should have, right? And I think the last 2 years have been very, very critical, and I think have been have brought in a massive realization, right, in the overall healthcare industry. And I think it's getting institutionalized. It's getting just so much more smoother at many levels. Technology integration has become so much more savvier, and I think that just opens up a massive opportunity for you as a fintech player. We're going to cover all of that through the course of the conversation. Saurabh, I'd love to open this conversation with a quick round of introduction, by you and on the leadership of DigiSparsh. So yeah, over to you.
Thank you. Hello, everybody. My name is Saurabh Soni, and I am the co-founder and CEO of DigiSparsh. Just to give you a quick background about myself, I come with 2 decades of experience in corporate world, worked in 3 different industries, which is financial sector, telecom sector, and consumer goods. Worked with brands like GE, with Tata Group. I was also the CEO for SL Group, SL Group's financial services company, which is the parent group of brands like ZTV and Dish TV. I've also worked with Idea, which is now Vodafone Idea, and I've also worked with Berger Paints. Overall, in my career, I've worked right from a management trainee level to a CEO, CXO level. Have built companies for my past employers, have taken businesses to a different level, sold companies and bought companies as well. So I and Akhilesh both understand this trade of launching a company from scratch and taking it to the next level. In fact, my co-founder Akhilesh Gandhi, who is right now in US, so he couldn't attend the call, he also is a person who has built companies from scratch and taken it to the next level. He was earlier the co-founder of Shop Kirana, which is one of the famous company in the space of logistics in FMCG business. He has built another software development company, which is a 100% owned company by his family. And he has worked in US for almost about 10 years with brands like SanDisk, Federal Bank of San Francisco, even as a consultant with Google for some time. And both of us come with this background of building businesses and taking it to the next level. Both of us have complementing skill sets because Akhilesh is a hardcore techie and I come from completely a business background. So from that perspective also, it's a complementing skill set scenario between the both of us, where we try to provide a lot of value into the domains that we come from. And that's broadly about our introduction. Between both of us, combinedly, we have 4 decades of experience. I mean, I also have 20 years of experience and Akhilesh also has 20 years of experience.
Super. And I think in today's time, especially when you're trying to build something in the financial services ecosystem, right, or the lending ecosystem, for example, right, I think that experience just comes in so much more handier, right? That's essentially how I look at it, right? And I think that experience of what you've done across industries is going to be just so much more relevant across the current set of operations that you have. I want to move into talking more about DigiSparsh, right? Now, typically what we come across and what we see when you're looking at a startup, right, it's solving for one problem, right? So either it will be a patient or it will be a hospital or it will be supply chain with the suppliers, right? Now with DigiSparsh, what you're doing is massively comprehensive, right? You're solving for everybody, in that entire value chain. So I'd love you to break it down for us, and in order of priority, right? Which is the one you're going to first, and then how you're solving the other pieces. Would love to hear that.
Yeah. So Ashu, I'll just quickly talk about DigiSparsh, and then I'll come to specific points of why are we looking at the entire value chain, not only particular one segment. Mm-hmm. So DigiSparsh is the only healthcare lending company in the country that cuts across the entire value chain. Sure. And we fund all the 3 segments, the predominant segments, which is patients, hospital, and suppliers stroke merchants, right? When we started this company, before that, we actually studied, I would say roughly around 30 to 35 companies across the world which are into the space of healthcare financing. Right. When I talk about Indian companies which are already there, or some of them which were there and are not in existence now, to the ones which are there in US. I mean, I can give you some companies' name in US that we have studied very, very deeply. Someone like a Care Credit, someone like a Walnut, someone like a Benefits, to name a few. In India, we studied the Bajaj Finance model because they are the They're the largest one in the patient financing segment. Then we studied some large NBFCs who are very focused into hospital and healthcare segment, but in the SME space like a Ugro Capital, to some startups which have come into this particular space.
Sure.
And what we realized was that each one of these companies, especially in India, is focusing on any one segment, and especially patient financing as a segment.
Right.
The run-of-the-mill product that everybody offered to the hospital was that I will give you a 0% offer, and I will charge a subvention to the hospital. That's a 0% offer to the customer, and I'll try and convert uninsured customers for you.
Right.
And in that, what we saw was the problem pertaining to the hospital or the problem pertaining to the conversions was not properly met.
Sure.
The second thing that we did was we would have spoken to at least 50 to 60 CXOs of the hospital segment in the country, whether it was a CFO or whether it was a promoter, one out of the two. Between me and Akhilesh, we spoke to roughly around 60 guys. And each one of them told us that we are not at all satisfied with this approach of a financer coming and telling us that I will charge you a subvention, you take a 0% loan offer for your patients and promote it into the market.
Sure.
This is not how it is scaling up.
Right.
And even someone like a Bajaj, with the kind of might and the kind of war chest of money that they have, and with the kind of business that they have built, there is a huge mismatch to it, because in the span of 5 years, they would have done at least 10 times of what they have done in healthcare financing as compared to what they have done in consumer durable financing.
Sure.
Now, keeping all that in mind, and keeping my experience of past where I've done a lot of business in the B2B2C space, where we go and do a tie-up with a healthcare aggregator.
Right.
Healthcare aggregator then further goes and acquires the end customer for us.
Sure.
What our business model, or we zeroed down to that as our business model. So the first moat of the company is that we cut across the entire value chain. So when I go to a hospital or when I go to a healthcare aggregator and when I do a tie-up with them, we tell them that I have a product for hospital, I have a product for patient, I have a product for your suppliers.
Right.
Cherry pick which one do you want. So when my sales guys or when my business development guys go onto the field, they have a product basket with them, and it is as per the requirement of the hospital, as per the need of the hospital, that the product is pitched, and then we allow the hospital to choose and tell that which product do they want, rather than going and bulldozing them with one product and saying that this is the product that I have and you should take this product. We give choice to the hospital. So from the perspective of cutting across the value chain, that's one big differentiator. The second, as I said, that we are a B2B2C player. What it means is we don't directly acquire the hospitals or the end customers for that matter.
Sure.
We have healthcare aggregators in between. Now this aggregator can be someone like a Practo, which is a teleconsultation player, which can be someone like a Pharmacy, which is an aggregator of a lot of suppliers and pharmacies, or it can be someone like an IU Health, which is an aggregator of hospitals and patients, or it can be someone like a claim processing player who goes and acquires hospital and tells them that I will outsource your insurance processing desk for you, so that the hospital focuses on their core activity, which is medicine. What we do here is we go and tie up with these aggregators, we bundle our product with their product. So during the IPL campaign, you saw a lot of ads of Practo running on television talking about surgeries. Rahul Dravid was their brand ambassador. A lot about it. Every single customer over there who was opting for a lending product along with the surgery was offered a loan through DigiSparsh platform.
Sure.
So what we are trying to do is we are trying to bundle a surgery with a loan. We are trying to bundle insurance desk outsourcing with our claim financing product. So in that way, what we have to do is we have to go and do tie up with these aggregators, and these aggregators in turn already have the end customers on their platform. What we do is just bundle the product. Now this as a model is prevalent in the payment space. This as a model is prevalent in the e-commerce space, but this as a model was completely missing in healthcare space.
Interesting. Saurabh, please, sorry, go ahead.
Yeah. So this is how we try and develop the moat for the company, where we become a one-stop shop for the healthcare financing through all the three segments, and On the business approach piece, it is a B2B2C approach.
Interesting. Now, sort of, are these relationships exclusive? For example, when I look at your website, right, there are many players that you've highlighted in the process, right? I mean, there's a Vidano, and then there is a Farm Easy. I see Glamio Health, right, and there are many other brands that are there, right? Practo. Now, are these the relationships that you have? Are these exclusive relationships, or are these players open to have partnerships with other players, right? And why do I ask you that? Sort of, is that today there are a lot of infrastructure, fintech infrastructure companies that are coming, right? There are companies that are offering infrastructure for BNPL products, for example, right? There are companies that are offering infrastructure where you can have your own fintech at play, right? And they sort of empower you in the process. Now, so what I essentially want to understand is, one, are these relationships exclusive that you have? Second, there are these infrastructure companies that they have amazing products that are available, right? Literally a plug-and-play solution which can empower many of these players in under 15 days, 20 days to offer their own lending options, right? And products in that process. How is this relationship, or what are the dynamics of this relationship? I'd love to understand.
Some of my relationships are exclusive, some of them are non-exclusive, and in some of them have the first right of refusal. And it would be incorrect on my part to come and say over here that every single relationship is an exclusive relation, because I know the aggregators who work with me also have many other products which are related to financial services, and their scale, they would like to have multiple players on their platform. But what we have done, and one of the points that you talked about was of these infrastructure finance companies, where embedded finance and other things comes into picture. What we have done, Ashu, is that technology per se should be rather used as a catalyst for doing business. But the moment you go and talk about doing API integrations and having 2 weeks, 3 weeks, or 4 weeks of time to integrate an account and make it live, we have completely moved out of it. And we have had a plug-and-play platform, which means I go to an aggregator and I say, let's sign the agreement. Please have your user ID and password, and let's start the process immediately. If you want to do an API integration, we can do an API integration, but that does not mean that we will we will not start our business till the time the API integrations are not done. In a similar fashion, the same platform is offered to a lender, where the lenders who tie up with us can utilize the same platform for doing or onboarding the customers. And in a similar fashion, the same platform can be offered to an aggregator to a hospital if the hospital directly comes onto my platform. So what we are trying to do is, in real sense, the technology platform are being monetized in a manner which are plug-and-play platforms, and the customer can utilize those platforms immediately.
Interesting. Sort of, are these white labeled, right? So when you're doing it, for example, with these brands, right, are these white labeled, or you continue to operate on the option?
This is a branded platform of DigiSparsh, and we don't white label the platform.
Interesting. I'd love to understand the financial model, right? The financial engagement that you have, right? Now, given that they are essentially the ones who are burning the cash, right, to get the customer. What are the commercials that you usually get to? Now, you could give me a larger sense in case you don't want to sort of address it very specifically, but you'll have to, and you should give me a broader sense, right? Because in general, people should be interested to understand your the business model and the complexities around the business model.
What I'll do is I'll break up the commercials not in terms of number, but in terms of the construct, which will give you fair understanding. There is a limited rate that a lender charges me at my backend. Let's say that's X%. Okay. Now X%, and when I add my spread into it, it becomes say X plus Y%. Now this is the rate that I give to the aggregator, and I tell them that this is my landing cost to you. If you want to bump it over and above this X plus Y%, you are more than happy to do it your end. But this is my landing rate to you. So when I charge the aggregator a certain percentage, or to its end customer a certain percentage, it is that X plus Y%. And this X plus Y% is nothing but the rate that the lender charges me, and I beef it over with my spreads. I can give you a broader idea about my spreads for my out of the 3 products that I have, and I talk about those 3 products also in detail. My patient financing spread is the highest spread. My other 2 spreads, which are the hospital financing and supply chain financing, because those are invoice discounting products, so over there the spreads are lesser. But what I can tell you is those are volume intensive products because of that, the volumes are higher. One hospital, when I onboard, I immediately get a 50 lakh or a crore rupees of kind of a credit line approved for a hospital like that.
Interesting. I have a bunch of questions on that one, but I'm going to complete in just a bit, right, on those particular points. Sort of what I want to understand is, tell me a little more about the underwriting that you're doing, right? Typically in healthcare, what has happened is, and there have been companies which have been a little averse to lending in that environment, right? Is because, when a patient, and I'm talking about the patient right now in this current company, because that's your primary product, right? Now, what typically happens is the ability of the patient to sort of go out and repay, right? If he or she is going under a serious surgery, becomes a problem, right? So, are you here doing, daycare procedures more? Are you funding that? What's the, I'd love to have visibility on that, right? What are the, for example, pieces that you're kind of funding right now, and the underwriting piece? How are you kind of, that becomes your very critical mode in the process, right? I would love to understand a little more about the underwriting that you do.
Yeah. So before I talk about the underwriting, let me just give you a gist of all our 3 products that we have.
Sure.
That it is a clear-cut understanding about first what are the features of the product, and then I'll explain about the underwriting piece as well.
Sure.
Our first product, which is for the patients, is a very unique product launched by us for the first time in the country.
Sure.
This is a reimbursement financing product. When we started looking into patient financing, we realized that we will have competitions with the likes of Bajaj Finance and HDFC Bank in the country.
Sure.
We were completely aware about the fact that we will not be able to compete with them in terms of the rates, because their cost of fund is way lower as compared to what we can even expect or think about. Now, what we did was we studied the patient financing, and what was very striking to us was that in India, in the year 2020-21, there were roughly around 58 to 60,000 crores of claims that were registered in health.
Right.
Out of that, 24,000 crores worth of claims were reimbursement claims.
Right.
The patient had an insurance, but the patient could not get a cashless cover.
Sure.
It meant that the patient had to make the payment out of his or her pocket.
Right.
Get the treatment from the hospital, get all the documents, collate them, submit to the insurance company, chase the insurance company, and then get the amount settled.
Sure.
All of this when the patient has already bought an insurance policy.
Sure.
We felt this is a huge pain point. And even the hospitals told us that to solve this, and this was also a pain point for the hospitals, because the hospitals were actually losing patients because the patient wanted to have a cashless cover. So what we did is we went ahead and productized a solution where we now offer every single reimbursement case into a cashless case conversion through a reimbursement financing product, where we make the payment on behalf of the patient to the hospital. We collect the documents. We, through our processing partners, submit these documents to the insurance company, get the claim settled into the account of the patient, and once the patient gets the settlement done, we already get an electronic NASH signed from the customer. We trigger that electronic NASH, and that amount comes back into our kitty.
Interesting.
Which means that the patient does not need to do anything. Neither needs to make the payment, nor needs to collect the document and submit it to the insurance company, and also does not need to go and chase the insurance company. Now, for a product like this, from the underwriting perspective, apart from the bureau score or the bureau cuts that you look, we also look at underwriting the insurance policy through our processing partners, who will then tell us that what is covered and what is not covered in the insurance policy. How much is the sum insured left, whether the treatment for which the patient has come is getting covered under the policy or not, and then the claiming and the processing partner or the claim partner also provides a collateral for this, so that in the game is also involved, so that if there is a risk associated to it, then it is his risk associated for that particular piece.
Interesting.
Now, this is what we do and integrate onto our platform. So on our platform, when the customer or the hospital uploads the details, automatically details flow into the claim processing partners team, and also at the back end to my lending partner. And within few minutes, we come to know that what is the whether through a bureau cut, whether the customer passes that test or not for in terms of giving a loan or not, and also from the insurance policy perspective, whether that policy is live or not. So that is how the underwriting of a patient reimbursement case is done, which is our first. Our second product is a cashless claim financing product for the hospital. Here, the hospitals who have cashless tie-ups with the insurance companies
Right.
have to wait for anywhere between 45 days to 60 days to get the cashless settlement from the insurance company.
Sure.
There are some private insurance companies who do it in 15 days, 7 days, 10 days also. There are some companies who do it in 90 days also. So the average of the industry is anywhere between 45 to 60 days.
Sure.
What we do is, we go and tell the hospital that we will give you this money instantly. The moment you submit the claim, next day you'll get the money. You don't need to wait for 45 days.
Sure.
And we charge obviously a certain rate of interest for this.
Right.
We also tell the hospital that if you want, we will outsource your entire insurance desk through our claim processing partner, which is a value-added service that we provide to the hospital.
Sure.
And this is a non-collateralized loan that we offer to the hospital. It's a completely digital process because it's an invoice discount product. Now, this results in the removal of the blockage of working capital which otherwise the hospital faces, because usually out of the CC limit that the hospital has, 60% to 70% of that is blocked against insurance receivables. So they're not able to get into their business expansion or bed expansion or an acquisition of new hospitals or purchase of new medical equipment or managing their suppliers or OPEX. All of that gets very loaded because most of the CC or the OD limit facilities are blocked against insurance receivables. And if we are trying to remove that for the hospital, then it's a big plus point, or we are trying to remove a big pain for them.
Sure.
That's the second product. And the underwriting of this, we, apart from looking at the financial health of the hospital, also look at the last 6 months cashless transaction data. There are a lot of cuts that we look into it in terms of turnaround time of the hospital to get the money from the insurance company. How much time do they submit the claims? What is the disallowance percentage? There are quite a few things that we look into it. Now that is a model when we present to our lenders get a lot of comfort, because they then are able to understand and see that here is a healthcare financing partner who understands the underwriting piece of healthcare and then onboards a customer for us.
Interesting.
This is our second and the final product on the supplier, which is also an invoice discounting product.
Right.
It's very similar to what we do in the cashless claim financing. The only difference here is the transaction data is between the purchase and the supplies that happens between the supplier and the hospital, and how much time the hospital take to make the payment to the supplier, and how many or rather what is the percentage of the goods returned back to the supplier. These are broad contours basis which the entire underwriting model is built. There are 3 products and the underwriting model associated with it.
Super. So when I look at it, distance, right? I think the underlying thesis is that of bill discounting, right, across all of these 3 products, right? That is the constant, right? And I have a bunch of questions on that one, and I'm going to come to that in a bit, right? But before that, I want to understand, right? What's the spread right now? How many loans, for example, have you processed? How many customers have you tackled? Which are the states that you are active in, right? I'd love to understand some of the challenges, right? From a scaling standpoint. Given that a large part of what you're doing is essentially all tech, right? Does this needs you to have a certain physical feet on the ground sort of structure from an acquisition standpoint, or that will never be the case because you're largely sort of partnering and you're in a way riding on top of these partners that you have to get to onboard the customers, right? Be it a patient, be it a hospital, or be it a supplier. Would love to hear that one.
So I'll touch upon this particular question of yours in terms of acquisition first. The beauty of a B2B2C model is it allows you to have a very lean team, and you can build your business largely onto it and scale the business. Just to give you some idea, we are a team of 14 to 15 people right now. Out of that, I just have 3 BD guys. And 3 BD guys have sourced more than 5,000 loans for me already. And in terms of value, roughly around 40 crores already. What it means is, I'm into a stage where just with a team of 3 people, I'm able to source business which other healthcare finance companies, I'm talking about the startup ecosystem, were able to do with a team of roughly around 40 to 50 members. And why has this happened? Because we are a tech-driven company where we integrate our platform with our aggregators platform, and also because our model is a B2B2C model. So just come to think of it, between all of my aggregators, the total number of hospitals that they have is more than 1,000 actually. The ones that we have reached today through our products is more than 600. And if I had to go and acquire 600 hospitals, I would require a very large team of boots on street who would go and then acquire these hospitals, which today I do not need to invest into. I just need to have intelligent business development or alliances managers who go and acquire these aggregators by going and tying up with them. Now,
interesting.
From the perspective of the numbers that as I told you, which you asked, that how much have you guys done in the last tenure of roughly around 10 to 11 months, we have done more than 5,000 loans and disbursed in terms of value roughly around 40 crores, $5 million.
Interesting. Sir, what are the locations that you are active in right now? I mean, are you largely in tier 1 or tier 2 is also something which is
so we have disbursed loan in around 54 locations already. We are location agnostic. We are more concerned about if a partner or an aggregator has a presence in that particular location, we need to serve that particular location.
Right.
And because we also have the aggregator skin in the game, so the collection becomes far more easier, as in if and all there is a bounce in the customers segment. Now, in 8 states, in more than 53 locations, we have disbursed loans. But yes, our predominant business comes from the top 6 cities of the country.
Sure. Interesting. Now, I'd like to touch upon a little on the aggregator, right? Now, given that you're dependent on them, right? Now, there have been articles, there have been reports that have come in, and where they've been discussing about the aggregator model, right? And it's not a happy picture, right? Let me put it this way. Right. I mean, patients are being handled in a certain common way. The NPS is terrible, right? It's a very aggressive model of work, right? It's a very different rub-off. The larger, for example, institutions, right, and the monetary bodies are also sort of considering a lot of regulatory changes, right, and then liability and the reporting structure, so on and so forth, right? There's a lot of work which is happening in that front. Essentially riding on top of an aggregator model, right, or partnering with an aggregator model and kind of that being a primary strategy. Don't you think you run the risks that these models do? That's number one. Number two, the possibility of disputes increase because of the aggression and the numbers that you chase. And third, your ability to upprice yourself, right, and build a visibility for yourself as a brand. What's your sense of it? When you are riding on top of a partner, it basically you get commoditized to a large extent. What's your sense of all of these challenges that are there in such partnerships?
The first thing that you spoke about was that the quality of business that an aggregator generates, or the way they generate, right? Now, when we onboard a customer, whether it is a hospital or a patient or a merchant, we don't leave everything to the aggregator. There are checks and balances, and there are verifications that we do at our end, and it is not only the verification from the perspective of the financial health of the customer, but it is also the verification from the perspective that whether this customer actually wanted a loan or not, or whether this customer is
or this service is required or not.
Yeah, the service is required or not, or the loan is required or not, and whether this customer is deceived by showing a very different picture as compared to what actually is the product offering. Now, we as a team are very conscious about the fact, and we have a verification team that works works on this particular area, and we are extremely vigilant and circumspect on this particular aspect, that if the customer is not clear, or if the merchant is not clear about the lending product that is getting bundled along with it, we do not disperse them. I have been there and done that earlier as well. In the lending space, in micro loans as well as in SME loans and consumer lending. So with those kind of learnings, it is far more clearer to me to understand that how is this business done. What are the checks and balances that needs to be kept over here. Some of our products are very virgin products which were launched for the very first time in the country, and even for us there were some learnings associated to it. For example, the reimbursement financing product that we launched in the month of November till March, I got so many learnings, and those learnings were then implemented in the month of April to see that how do we ensure that we weed out the bad customer, or a customer who is not wanting to have a loan but still is being given a loan in a manner so that at the time of sourcing itself, those things and those checks and balances are maintained.
Your ability as a partner, right? When you're piggybacking this infrastructure, right? There's something called an abnormal profit zone, right? Now, when you're building a B2C, even a B2B sort of a business, right? And there are many lending players that have come in, right? There's a certain relationship that you're establishing with the customer, right? In your case, because you're piggybacking, right? Doesn't that get you into a commoditized one? Second, your relationship. How do you ensure that the relationship is established, right? That tomorrow, if you change the model or if there's a new distribution channel that you can explore, there is a certain recall that they have, right? How do you ensure that for that?
Yeah. So I'll again tell you two things over here. The first and the foremost thing is we are neither a B2C model nor a B2B model, but we are a B2B2C model, right? Sure. So in a B2B2C model, the B in between, which is the aggregator, plays a vital role. But that does not mean that DigiSparsh as a brand does not exist in the healthcare ecosystem, or the hospital ecosystem or the healthcare ecosystem is not aware that there is a company like DigiSparsh which is providing these things. Right from the platform perspective which is used, and which is, as you talked about, that whether it is a white label platform or a branded platform, it's a hardcore branded platform of DigiSparsh only. We do not allow aggregators to white label our platform and provide it to the end customer. Number two is, we are also clear from the perspective that there is a team of people who go and acquire large accounts for us, and those accounts are not the accounts which are acquired through the aggregator ecosystem. Those are the accounts where my core team, my alliance team, goes and acquires those large accounts. The third thing is, this entire health tech or health aggregator ecosystem in the country right now, Ashu, has I would say bloomed in the last 3 to 4 years. I every month see so many healthcare aggregators opening up their business, or an existing company getting into a healthcare aggregator space. Now, I'll give you an example to support what I'm trying to say. I have a product that I've launched, which is in rural healthcare financing, where an aggregator goes and opens health kiosk in the rural market, and I lend to the franchisee owner of that health kiosk in the rural market money to establish the kiosk, and then the plan is further to give money to the end customers who come to that kiosk for treatment, and everything is backed by the aggregator in between. Now, why is this important? This is important because if I have to have that kind of reach in the first 3 to 4 years of my business, then I need to immediately tie up with as many aggregators as possible and have my reach in this market. Once my reach is established, and once I have built a sizable business, and then if I have to take a call to launch a B2C product also, I'll be far more comfortable in doing that, because I have then by that monetized my business in a certain manner where I've built book, I've built a business, I've built a brand associated with it.
Interesting. Sir, I'd love to understand a little on the delinquency side of it, right? Now that's a constant problem when you're doing healthcare. That again becomes an issue. What's the status on that? On the delinquency.
Sorry?
Delinquencies.
Okay. So I'll give you a construct of our NPA of all the 3 products that we have. When it comes to cashless claim financing, which is the numbers that we do for hospital, or whether it is merchant financing, cashless claim financing, we are sitting on a 0% delinquency right now. We have not seen any hospital going delinquent till now. As far as merchant lending stroke supplier lending is concerned, we have seen a delinquency of 1% over there. When it comes to patient financing, especially in the reimbursement product, over there our delinquencies are in the range of somewhere around 3%. At a blended level, we are somewhere around 2.5% of all the 3 products put together. Our patient financing contribution is higher. Also, in patient financing business, as I said, this is a virgin product that we launched in the market. We also saw many things that we saw from October, November till March, and we have applied those checks and balances. And from April onwards, I see a very stark difference into what we saw in the earlier sense. But at an overall level, the company is into the range of somewhere around 2.5 to 3%.
Super. Okay. Saurabh, we're going to move last question in this conversation. Second last question, right? In this conversation, what are the next 2.5 years like? What is it that you? So you essentially, I think one thing is very clear that you were looking at the aggregator ecosystem to essentially build your depth, right? And the book is very clearly a priority. Systems are improving in the process. Now, what are the next 2.5 years like, right? What's the reach? What's the length and breadth that you can sort of cover? Are there milestones that you've put together?
Yes. So the first milestone is 100 active aggregators.
Sure.
Right now we have onboarded 20, we have 12 of them as active. Our plan is to have 100 active aggregators. And in the next 2 years space, we need to have a book where a total disbursement of the business is close to about 1250 crores is what we are looking at. And apart from this, if you want about profitability, we are looking at breaking even in the next 2 financial years. So that's where, from the perspective of profitability, from the perspective of books, and from the perspective of aggregators is concerned. We, at a steady state, once we are in a zone where we have an open book of more than 1,000 crores, we'll be in a position to start developing a B2C model as well, where we can have a brand which can be associated directly to the end customer segment, which is a merchant or a hospital or a patient. And by that time, as I said, we have monetized our business in a certain manner. We have built our books in a certain manner. That will be far more comfortable to spend money over there. Fortunately or unfortunately, both me and Akhilesh come from that school of thought, where along with scale, profitability is also equally important for us.
Right. I think we started to value that. I think that's a system, right? That's interesting. Sort of last question. There's some amazing representation in your cap table, right? Do you want to talk about that? It'll be nice to sort of for the audience that is there. It'll be good to have a view in terms of some of the investors that are there, and how does, for example, what are the valuations there, a bunch of other things that you can, if you can give a sense of that.
Yeah, our first round of funding was done by a Silicon Valley-based VC called Go Ahead Ventures. They gave us money in the last year of June 2021.
Sure.
And after that, during this bridge round raise, we have got money from another micro VC based out of India called Capital A. A very senior ex CXO of HDFC Bank has personally invested in the company, and we got investment through the AngelList platform, which is AngelList platform is actually a US based platform, but they also have an and over there also through the AngelList platform there are founding partners of VC firms. A very senior executive who's an Asia Pacific head of a healthcare company has also invested in our company, apart from some founders of SMEs and others who have also invested.
Super. Phenomenal.
Sorry, I just missed. We have very recently been selected by the Startup India Seed Fund, and they have also invested in us through a CCD route.
Interesting. Saurabh, thank you so much for doing this. There is all good things have to come to an end, and so does this one, right? There are many questions that I would have loved to probe you further on. Part of the job, right? But I think now we're going to address some of the questions that have been put out by the viewers and the listeners that we have right now. Logged in. I'm going to read it out, and you can continue to sort of answer that. There'll possibly be questions that you've already answered. We're going to spend lesser time on that, with just a caveat, small point, right? So question number one is, what is the debt structure at present? How much debt have you raised?
So see, because we are not an NBFC and we are a fintech, I haven't raised any debts on my book. What we do is we do an off-book lending tie-up. What it means is that, for example, if there is a loan that is disbursed to the end customer, that is disbursed directly from through the balance sheet of my lending partner, and if the lending partner charges an X%, as I said in my example earlier, I beat it up with X plus Y%, and that Y% is my spread which the lending partner shares with me.
Interesting. Saurabh, just a quick one on that one. Do you have FLD arrangements? Those measures have, for example, all lenders have become so much more averse, right? Especially with what has happened in the last 2 years. What's the status on that?
So for every product, I don't have an FLDG arrangement. I do have arrangement for some products, and that is a fact. Also, from the perspective of one of the things which is extremely important to understand, and that why RBI has gotten very strict, is that with some of the lenders and large NBFCs or banks, is that they are completely passing the underwriting to the fintech players, and they themselves are not doing anything. In our case, it's not like this. The lending partner also is very circumspect to the fact that how is the customer onboarded. They themselves also do the underwriting. In fact, they have their own checks and balances which are applied beyond what I do and how I underwrite. So from that perspective, we are far more comfortable, and we know that it's not a blind spot for the lending partner to say that, okay, how are we going to do this? The second thing is, We are also in the process of raising a 50 crore round, and we are going to apply for our own NBFC license after that.
Interesting. Sir, I want to understand, right? How competitive are you on your cost of funds bit, right? Because that becomes very, very important in this ecosystem, right? How competitive are you on that front?
Good question. See, what happens is when you are in your embryonic stages, it is bound to happen that your cost of funds are going to be higher as compared to your larger players in the scheme of things. But what also happens is, because you come from this industry and you know that what are the nuts and bolts and what are the nuances present in order to get the cost of fund down. I won't say that we are extremely cheap, but I won't even say that we are on a very higher side. We're at a middle level, but at a decent level as compared to what a company which has just started doing lending would get. Also, the reason for doing a 50 crore round is that we will be in a position to bring our cost of fund down dramatically, because we will be far more adequately capitalized in terms of a balance sheet to go and talk to a large bank for doing a tie-up with us.
Interesting. So the next question is, please tell us about your cap table, I think, which you have already. Do you want to make a comment on the valuations, or is that something that you want to skip for now?
So see, I just read one of the questions also from someone talking about comparing us with the Bajaj in terms of the multiples and all. That's not an apple-to-apple comparison. I mean, Bajaj is way too large a company to get into this. So they are a company which is more built on the physical distribution side, also a blend of digital along with it. We are a company. If you look at our team, it's a low OPEX model, a model where we will scale. Just to give you guys some idea about it, we are a team of 15 people who has done disbursement of 40 crore. The target is the team will not grow by 40 to 50 members, but the disbursement number will be in the range of 1,000 crores. That means we are going to be far more lighter on the OPEX side and far more heavier on the technology integration side. That is why the valuations will be different. And if you look at our peer comparisons in terms of other healthcare finance company or other fintech companies, we are far more moderate as compared to what they have been.
The delinquencies kind of changed, right? The risks that you, for example, have changed, and that's largely that. And plus, they're in a public environment, right? And public environment has a certain perceptive range of thoughts. In a private environment, things continue to change, and I think you're a specialized player where you can continue to calibrate yourself, right? And like you said, I think technology becomes a very heavy part of what you're doing, right? Plus, it's a low team / capex model, right? Your growth continues to happen on the back of the partners that you have, right? I think the only thing that you need to try to optimize is delinquencies, which I think under control, the process of putting together, and more importantly, cost of funds, right? I think that just sort of becomes a piece for you. I think you answered question number 3, right, which was about the Bajaj valuation. So I'm not going to spend too much time on this. Now, there is another question. So do you only provide reimbursement services to the patients, or do you provide loans to uninsured customers as well? That's the next question.
We do provide to uninsured customers, but our marquee product in the patient financing space is the reimbursement service customer for 2 reasons. Number 1, we took the first mover advantage. We have built the most unique technology platform for that. Our underwriting capabilities are far more, solid over here. As far as loans to uninsured customer segments are concerned, we will have competitions with the likes of Bajaj and HDFC. And if I have to even match to their rate, that means I have to bleed. And as founders, we have decided that whatever business we be into, we are not going to be into a business where on unit economics we bleed. So we will not be getting into that business unless and until we do a tie-up with the bank after the 50 crore run. And also, we have I can't reveal the details or the nuances of the product, but we have already structured a very disruptive uninsured loan product for the market, but we are just waiting for the large round to get closed, so that we'll be in a situation to adequately promote that particular product through our aggregator ecosystem and also through the digital channels.
Very interesting. And I think to the uninsured customer, providing loans, I think, is a different ballgame altogether, right? I think the game that you're playing is more predictable, has more clearer visibility, right, in that sense. But I think we'd wait for this product that you're talking about, Saurabh. Next question, if you do that, how do you decide that the customer is worthy of financing? I think which is in a continuation of that question, in case you want to sort of...
So I did talk about all the 3 underwriting models that we had, and how do we decide upon to which hospital to give loan, to which merchant to give loan, or to which patient to give loan. Also, from the perspective of an uninsured customers, we look at the bureau scores. Up to 50,000 rupee loan is given without any income documents, just basis the bureau cuts. Beyond 50,000, we look at certain income documents as well.
How are you neutralizing regulators in your space of lending? I don't exactly understand what they mean, but it's possibly, are you operating within the defined regulatory framework? Is there a gray area? I think that's essentially what they possibly do.
So as of now, any non-regulated fintech is out of the purview of the regulator. But having said that, there are a lot of discussions going on in the media as well. You would have read about where RBI is looking to regulate this entire industry through the regulated entities only, where the regulated entities will be very clearly told that how do you need to work with the non-regulated entities. What is it that you can outsource and what is it that you cannot outsource? Now, I don't know the inner details of it, but what I'm expecting to see is that there will be certain guidelines that will be given by RBI in the coming months or in the coming quarters. Again, I am not privy to that fact, but certain guidelines will definitely come. But we are far more comfortable because we know that, as I said, there is no blanket underwriting or there's no blind underwriting that is being done by the lender or by us. We are extremely careful in terms of what we do and how we do.
I think just a quick one on that one, right? That's more on the fintech and financing side of it. I think there are regulations that are expected on the entire model of, for example, aggregators, right? And the government is taking cognizance of this. There's a lot of hue and cry which is kind of happening. A lot of things written about that. I think that is also going to be very, very critical, right? And I think that's going to really define how businesses shape up in future, right? And I think that's going to be very important for Saurabh and his team as well. Just a quick point on that one. Now, Saurabh, moving to the next one. I have James, who's written, I am personally a manager of claims for hospitals. How is claim rejection and increased disallowance are managed?
Yeah. So again, this as a service is something that we provide through our aggregator partners, where given completely outsourced service to the hospital, where the entire insurance desk can be given to the third party. And the third party then gives you a certain commitment that this is, if your today's disallowance percentage is X, I will bring it down to X minus Y%. If your turnaround time is of certain days, I will help you get that turnaround time reduced from certain days to certain minus X days. And if you today have, there is a very technical term that I'm using, but because James is from the industry, so he'll understand. If there are certain MU discount percentages, I will help you reduce those MU discount percentages so that you don't need to shell out a lot of money to the insurance, to the insurers. Now, this as a service today is a service that we provide to our aggregator partners, and this is a blended product that is offered to the hospitals, where the hospitals can have the financing as well as the insurance claim settlement services both put together from us.
Interesting. Last question from my side, and then of course we're going to open it up for the audience. Saurabh, on the competition front, right? You have some players listed on your deck, right? How are your, this is a space which has been very, very exciting. A lot of people have been looking at it, right? How is your competition moving? Have you been kind of tracking that? Is the question.
So we do have competition, and the interesting part is we have competition for products. So, for example, I have competitors in patient financing. I do have a competitor in supply chain financing, or I do have a competitor in cashless claim financing. But the good thing for us is I haven't seen any one company which is a common player in all the three segments. So when we go to a hospital or when we go to an aggregator, the most the most heartening thing for us is when they say that, okay, here is one player who's like a one-stop shop for me, and I can go and park all my financial product needs to DigiSparsh, and then DigiSparsh will cater to a lender A for my consumer lending product, or a lender B for my invoice discounting product. Apart from the value-added service that we are trying to bring onto the platform, which means that unless and until I see a player who comes and tells us that I am going to be in the same segment in which you are, which is all the three segments, through an aggregator route, till that time we have a first mover advantage and also a virgin territory for all the three segments put together under one basket.
Interesting. Saurabh, bunch of other questions have come in, and I'm going to continue to ask you more. Right, what are the kind of exit investors here can expect, and by when?
Okay. Now, see, as I said that we as a company are going to apply for NBFC license and also are going to do raise. So according to me, in the next 2 years, we'll be doing 2 raises, and the customers will get exit in both these options. So if there's a customer who is looking for a short-term exit, can get a short-term exit over here. But if the customers are looking for long-term exits as well, then we will have options for long-term exits as well. The most important thing to understand in this business is that we are a company which is into the business of lending through the technology platform. Once we become an NBFC, automatically cash will become the raw material that we will require. Obviously, till the time we are not an NBFC, we can piggyback on the balance sheet of the lending partner to do that. But once we are an NBFC, we will continue to have a blended model, a model where we will do some business through our lending partners, because for a simple reason, over dependence on one particular channel, especially when you are a young or a new NBFC, can be very killing. And again, I've seen that in my earlier days when I was part of a young or a small NBFC team, and I've also seen that when I was part of a very large NBFC team, that the blend between the on-book and off-book is something that is very, very critical, and we will continue to do that.
Interesting. Sort somebody's asked this, right? Because it's a question I want to sort of ask this, right? Why do I need DigiSparsh where patients get cashless from medical claim companies in 3 to 4 hours, right? What benefit does DigiSparsh get out of that?
So 2 things over here. First of all,
Sure.
If it's a cashless product, rather if it's a cashless claim, then it is not the patient who is the borrower, it's the hospital who is the borrower. And as I did explain during my introduction, that there are some insurance companies who are extremely fast in terms of settling the claims. There are some insurance companies who are extremely slow in terms of settling the claims. Without naming the companies on a public forum, I can tell you the average settlement time is anywhere around 45 days. So you might not go and discount an invoice where you're getting the money the next day or after 5 days or 7 days or 10 days, but you would definitely as a hospital like to discount an invoice where you're getting the money after 45, 60 or 90 days.
Saurabh, last question from me this time. Who's the third party? So James again, right? Who's the third party vendor? Is it a credible party since they have an important role to play?
So again, we do not have an over-reliance on one party, but we actually at this point of time have tied up roughly 3 to 4 aggregators in this particular space. And just to give throw some light on this space itself has grown in the last 2 years. It was during COVID that these kind of services came at the forefront, and we have started tying up. And the advantage that again DigiSparsh gets into it is we invariably are the first partner with these aggregators or claim processors tie up with. In fact, when a new claim processor gets established into the market, their first call from a financing perspective is always to DigiSparsh. In fact, I've just closed tie-up with 2 claim processors in the last week. Both of them are run by very established ex-insurance professionals, but the first call again for tie-up did come to DigiSparsh.
Super. That's it from my side, Saurabh. I'll hand it over to the Tyke team.
Mahendra, you can ask a question.
Thanks. First, congratulations, Saurabh. And my question is it's simple. My wife is about to deliver in next couple of months. What is the process? Even I know the hospital where I should go, and my insurance is not cashless over there. What is the steps which I need to take as an end user to make use of DigiSparsh?
Right. So there are 2 things over here, Mahendra. Number 1 is that you need to find out from your hospital that if they do not have a cashless cover, and that as a cover is with a certain insurance company, if that is not there, then do they have the facility of providing a financing service associated to it or not?
No, they don't have it for anybody. Yeah, that is for sure, I can say.
So then there are 2 things that we do. Because we are a B2B2C player, we do not directly interact with the end customer. But if you go to my portal and if you put up a request over there, there are certain inbound leads that we get on a daily basis. And my sales team automatically goes and ties up. For example, in this case, you know the hospital where the delivery is going to happen, right? Then my sales team because this is an inbound lead for me, my sales team directly goes and closes the hospital, so that the patient who's wanting to have the service with us is able to get the desired service.
Okay, got it. That's it from my end.
Abhimanyu, you can ask your question.
Your NPAs are quite impressive. I just wanted to understand who is responsible for collecting the payments. Vis-a-vis, let's say for your patient product, wherein you're reimbursing the claims, or you're, invoice discounting the supplier to the hospital. Is it the aggregator or is it DigiSparsh who collects the payments?
So the first port of call is always to the aggregator, and it is very natural to have that first port of call to the aggregator for a simple reason, because they are the most closest to the customer, whether it is hospital or a patient or a supplier, right? I'll just give you some examples to establish this. We started with merchant lending, for our pharmacies, and we did more than 1,000 loans over there, and our NPAs were less than 1%. And this aggregator with which we did the tie-up had presence in 22 states. Out of that, we covered roughly around 8 states to start lending over there. Whenever there was a bounce, the first list always used to go to the aggregator saying that these are your merchants who have bounced the installments. The aggregator's sales team goes onto the field, talks to the customer, because they are interacting with the customer day in and day out. And once the interaction is done, our 90% of the cases used to get solved then and there using the aggregator route. Now, this is in case of merchant lending. When it comes to patient financing, it's a little trickier over there. What happens is, because we are doing a reimbursement financing, the interactivity element between the patient and the hospital is not for a very long period. It is for the period till the time the treatment is done. And at times, if there are post-treatment scenarios where the customer needs to come down for, OPD sessions or something over at that point of time. Now, if the customer's interactivity is high, then the probability or chances of the customer defaulting is low. But if the customer's interactivity element with the hospital is low, that means if it's just a one-time surgery and the customer goes, and if then the customer's profile is not up to the mark, then you do see that the customers go down and bounce their installments. Again, the first port of call is to the aggregator. If the aggregator is not able to convert, then I have a telecalling agency and a field agency who goes and collects. And also, depending upon the product construct with the lender also chips in over there and goes and collects the money from the customer.
Saurabh, I will, one quick question, right? I mean, given that you're talking about the collection process, now collection is the most difficult part, Saurabh, and I'm sure you would agree to that, right? I mean, I think if you hear people in the lending ecosystem, this is practically right, that it's all about collecting at the end of the day, right? So now, given that you're doing healthcare, given that the patient is in a fragile position, it becomes a very tricky sort of it just becomes tricky at an overall level, right? How difficult is that to handle? I know there are no this is not something which is quantifiable, right? But are there some special measures that you have to take in the process, given that you have to software recovery and all that?
Just to throw some numbers, because this is a typical personal loan that we give to the customers. Mm-hmm. In the personal loan industry, if I have to bifurcate the collection or rather the quality of portfolio, sure. If it is a loan which is directly funded into the account of the borrower, mm-hmm. then the NPA percentages are the highest. Right. If end use is defined, when I say that the end use is defined, means the loan is not disbursed into the account of the borrower, but the loan is disbursed into the account of the seller or the service provider, which happens in this case. The money is actually disbursed into the account of the hospital, not into the account of the patient, right? Over there are two segments where the portfolio quality or the bounce rate is not as high as compared to the overall personal loan segment. It is education and health. Education has the least of them, then comes health, then comes a normal portfolio. Actually, after health comes consumer durable financing, and then comes the normal personal loan portfolio. Now, from the perspective of how tough is to get the collections done, I would say there is no difference whether when I'm going and doing a normal personal loan collection versus a healthcare loan collection. The advantage that we get in collections, in fact, is that we always can loop in the aggregator or the hospital to get the money from the end customer. So it becomes a little easier for us rather than just going and directly approaching a customer who would have come to my platform directly or through my app directly for a loan.
Super. Yes.
Since you mentioned that it is similar to the personal loans, so do these borrowers, be it the seller, the hospital, or the patient, or the supplier, do they also sign up for something like the ECS we do with our personal loans also?
Yeah.
So that it is
electronic NACH form. It's an electronic form that is signed by the customer before the disbursement, and it is mandatory. If the customer doesn't register to it, then we don't disburse the loan.
Saurabh, thank you so much for doing that. It was a pleasure to host you, and hopefully we'll do another one very soon. It was fantastic, right? Thank you so much for taking through the entire spectrum of services that you're offering, right, and how you kind of building or playing within a niche, right? I think one thing which is particularly exciting is that the sensibility that you're kind of bringing in, all the experience that you've had, right? Where there's a massive focus on profitability while you continue sort of leverage existing ecosystem to scale, and hopefully we'll have a lot of other founders look at this and try and build similar sensibilities in their businesses, right? Of course, apart from many other things that they continue to do. So thank you so much for doing that. It was a pleasure to host you.
Thank you. Thanks a lot. Thanks a lot to everybody. Thanks a lot to the Tyke team as well.
Thank you.